All right, so welcome back to business. I have more business news for you, but tonight we want to start a conversation on the currency news and where the cedi has actually crossed the dreaded 5 Ghana cedi mark. We have a short report for you, then we'll continue with our stories.
The cedi's woes has been influenced by the sudden demand for dollars by businesses in the country to finance their imports. The local currency, which was trading at around 4 cedis 80 pesos just some 2 weeks ago, has now hit the 4 cedis 90 pesos range and today closed at 5 cedis and a peso. For many, the test now is whether demand would again outwit supply of dollars. For the cedi to depreciate further in the coming weeks, or the Bank of Ghana would increase supply for the local currency to slightly appreciate and come back to the 4 cedi range. If you work with the figures put out by the central bank, the cedi might have depreciated against the dollar by more than 10% as at the end of 2018. Some have argued that unless the Bank of Ghana increases supply of dollars to meet the rising demand, the local currency could depreciate further.
So now you know how much the cedi is selling against the dollar. Now tonight, we want to have a conversation around the financial rates in Ghana. Are the rates favorable, or is just one of the factors pushing the banking population to ignore potential Ponzi schemes and outrageous interest rates? Philip Namfuri is Joy business analyst and researcher. He joins me to dissect this very issue. Grateful for your time.
Thank you.
And glad to have you on Prime, right? All right, but first of all, we want to take a look at how the rates are on the Ghanaian market, and then we'll come back for the discussion.
Okay.
Interesting. So, Philip, a lot have said that greed is pushing the banking population to go for this outrageous rates and potential Ponzi scheme. But are these rates not telling us otherwise? Are these not factors pushing a lot of people into going for juicy interest rate? Do you agree with me? Okay,
Sandra, I'll start off from here. Greed is something that we cannot remove from the psyche of a depositing person or of an investor, e.g. you or I. So you can't take out the greed element. Whatever happens in the financial system, even if the rates are low, rates are high, if people are greedy, they always find ways of milking you and I. And if you're also in turn greedy, you also go in looking for high returns. Now, if you look at the Ghanaian financial structure, you realize that there's a preponderance of what we call money markets.
Okay.
That's where we have the fixed deposits, treasury bills, etc. You see that our stock market is still growing. And if you've realized, you see that have you ever heard of any scheme where somebody has set up a company and then it's trading and you realize that the company doesn't exist? It's always a case where somebody opens a company, takes deposits, promises high returns, and then it becomes unsustainable after a while. So you see that there's a preponderance of money market schemes, if I can call it that.
Okay.
So there's always giving of a deposit, then the promise of high returns. And it's what our market is used to. Even if you're going to look for money for your business, the first thing that comes to your mind is borrowing, debt. That's all for money.
And sometimes you don't think about the rate you're going to pay at the end of the day.
Yes, that all comes from the money market system.
Okay.
Our equities hasn't developed, and other forms of alternative investments hasn't really developed. So the preponderance of schemes in the country is all for money markets, deposits, borrowing, returns, and stuff like that. With regards to what we've seen, the data.
The rates, yeah.
Rates since I can say 2016, end of the year, have come down marginally. Rates, lending rates are still somewhat high, 26% like we saw from the data. Back in the day, it was at high as 30s, getting to even 40s. One reason why people are going for high interest rates, and I'll use the bank as an example. We had at some point 36 banks in the country. Now we have 23. The old banks, the big ones, the Barclays, the Standard Chartered, they had already mobilized their deposits from way back.
Okay.
So they had a base of clients that they don't need to go out chasing fresh deposits.
Right.
We have the new banks coming on board, and some of the local ones. And you see that they were struggling and competing with these big banks.
And mind you, they are chasing the same depositors.
Chasing the same deposits.
Right.
Because the high number of people are in the informal part. So they are going to put their money in the savings and loans, finance houses, and we'll come to them. With the banks, you see that the banks are struggling to chase what everybody else is chasing. So what do? You promise somebody a high return on his deposits.
Right.
You in turn, when you take this money, you have to go and lend to somebody at a higher rate. And banks make money from what we call their spreads, difference between the lending rate and the deposit rate. So obviously, it's going to have an effect. So you have people promising, banks promising big rates. And there was a time where people's lending rates were as high as 33 to 40%, which means that the money you have taken on deposits is also equally high. So it has to balance out.
And this is really common at the microfinance and savings and loan sector, where they want to outperform the other. So the next one comes and say, okay, I have higher rates, so come to me and all that. But for me, in all this, there seems to be some sort of regulation when it comes to the commercial banks. But when it comes to the savings and loans, as to how much you're supposed to give lending out to the banking populace, there's no sort of, do we have a regulation at all in the first place?
Let me just quickly bring this in. You know, when banks are mobilizing deposits, they have a full force. When you talk about the bank, you think big. When it comes to finance houses, savings and loans, microfinance institutions, they are smaller. Their cost of mobilizing funds from you and I is way higher. So that's why they are pushed to promise us high interest rates. So maybe somebody will say treasury bill rate plus 5%. Currently, treasury bill is around 16%, let's say average, 13%. Back in the day, treasury bills were doing 20-25%. So if someone says treasury bill plus 5, that's 30% plus. If he takes this money from you, you are excited. Yeah, you understand?
Yeah.
But he has to lend to somebody at a higher rate to pay you back. And sometimes it becomes unsustainable because you go and borrow at such a high rate and something happens within the economy, you are knocked off and you can't pay back the loan. And then you see that every time non-performing loans are going up and you that have put your money there, maybe you are going to redeem your investments and you can't get it. So with the banks, there's the Ghana reference rate, which is standardizing their lending. Which
commercial banks?
Commercial banks.
Okay, but not the savings and loans.
Because I remember I spoke to the MD of a finance house right here in Ghana, and he says he's not going to be guided by the by the Ghana reference rate because his cost of funds is higher. What he's trying to get from people, he has to give something a bit above what the banks are
Philip,
doing.
but that is unfair. Don't you think that it's up to the regulators and the relevant institution to protect everybody across all board?
You see, with banks, you can offer a guaranteed rate. With investment houses, you can't, like the SEC says. So if he wants to entice you, he can say, okay, I'm going to give you treasury bill plus 3 or 4%. It's up to him to do the right lending or place the money in the right places to give it to you. But you see, it's all part of our financial system.
Right.
There are a lot of people who are not in the depositing system. Just a few of us channeling the funds. And we keep on talking about growing the pensions market and growing the life insurance market to provide room for funds. Elsewhere in developed countries, you see these high rates roaming all around the place. So you still have a lot of high rates in the country because of some of the problems we experience.
Quickly, 30 seconds. Sometimes a lot have said that, some have argued that I go to put my money at the bank. At the end of the year, I get only 3%. Yet, like you said, the lending rate is high. So if a company like Men's Gold is coming up to give me 10%, I'll certainly run after them. Is that not one of the reasons?
It is, but you see, it all boils down to financial literacy.
Okay.
Banks are taking money from us to lend to somebody. Like I said, if you're going to take at a higher cost, obviously, if you give it to you as a loan, it's going to be higher. And savings deposits don't really give much. If you want to get money from a bank, put your money in their fixed deposits or something like that. And we saw it from the data, the 3 months and the 10 months. It gives you a bit higher. But if you look around the broader economy, if interest rates are trending downwards, obviously you can't go and be taking above something else.
All right, grateful for your time. Philip Namfuri is our in-house analyst and researcher. And let's do something tonight from the commodities market. And then crude oil actually traded today at $60.81 per barrel after going down marginally by 33 cents. It's a wrap tonight on Business with me, Sandra Essenam Afternoon. Let's do business same time tomorrow. Have a great evening and thanks so much for your time.